What's going on, everybody? Kevin Cage here with another crypto update. I hope everybody's doing well and you're not going to want to miss today's video. In full disclosure, my voice is going in and out, so apologies in advance. We're going to go through a bunch today, and you're not going to want to miss any of these examples. A lot of investors don't even realize this, and there is so much opportunity in volatility. So let's talk about the obvious. Back in October, Bitcoin reached an all-time high price at $126,000, a little above that. And then since then, we crashed or liquidated, aka cascading liquidations, to as low as just above 80K. And checking out coinglass.com to look at the liquidations, we can see the top 10 crypto liquidation events of all time. The event was US tariff hike on China, $19 billion in liquidations on October 10th. And going down to the daily time frame, when was October 10th of 2025? Right there, this big liquidation. Pretty much beginning our overall downtrend after creating an all-time high price. It all started right there. So I've discussed liquidations a lot over the past few months, especially since October. And what liquidations are high level is basically volatility. They can make prices move up or down very quickly. So in this case, when prices start moving down, anybody that's using leverage or in a leveraged position can get squeezed. So when they get squeezed too tight, they can get a margin call. So if they get margin called, that's actually getting liquidated or forcing them to sell. And what happens when you're forced to sell, that pushes price lower, and therefore that can even trigger more liquidations and get more people to get margin called, and it can become a nasty feedback loop. So that's why it can feel really violent on certain days or certain weeks, and it feels like the floor is just gone. And what we've been seeing in recent months is the crypto asset class is taking a big hit. Meanwhile, we have gold heading to new all-time highs today. We had the same thing for silver. So we're seeing a lot of money rotate, even some sold off in equities and rotating to safe haven assets like gold and silver. And a lot of people are going to be reading a single headline or read one rumor and just say, oh, that's the reason why the crypto market is red. I don't think it's black and white. I think it's gray. And crypto is just part of a broader market story. What's happening today is really important to understand because a lot of people think, oh, if the market's not always moving in a good direction, it's actually crashing, that everybody changed their mind about the long-term future of crypto. And the majority of this move is mechanical. These are liquidations. It's the market right now, not the market in the future. It's all a matter of perspective. So right here we have Bitcoin on the right on the monthly time frame, and then on the left we have the S&P 500. So looking at this, we would assume that the S&P 500 looks stronger, but when we actually measure the ROI and difference, I disagree. So when we go from the bottom of S&P right in, we'll just say 2022, same thing for Bitcoin, we're going to notice this ROI is roughly 100%. So it looks good, it's in a decent uptrend, or at least getting close to a top, or what it appears to be. But what happens when we measure the ROI for Bitcoin? Albeit, it's a lot more volatile, 700%. And it's a blessing and a curse because when we even just measure from the top for the S&P 500, it's not a terrible drop, a few percent. And then when we go to crypto, at least roughly measuring from Bitcoin for the top, that's over 30%, 36%. And that difference can be expected because looking at Bitcoin's market cap, 1.75 trillion, we can also check on 8 Infinite market cap for reference. So Bitcoin, $1.75 trillion. And we're over here comparing it to the S&P 500 market cap over $61 trillion, one of the world's largest indexes or indices. And we can do the same thing with gold or silver, even using gold's price all the way at this bottom in 2015, just roughly measuring, this is over 300%. There's no comparison. I just showed you even going back to 2019 for Bitcoin, that's almost 4,000%. So when in doubt about the crypto asset class, zoom out because all of this is temporary. The hardest part of investing isn't about being right, it's about staying disciplined long enough to win. Okay, next up, I really want to go over this, and this isn't financial advice to anybody, but this is what works for me. And I highly recommend everybody that have a plan. I know everybody's situation is different, but I hope this inspires you to come up with a plan that fits your situation. And I'm going to go through this relatively quickly because I already recorded this twice and my microphone cut out. So one of the most important things in the crypto space, if you're an investor, not a day trader doing risk management and scalps and all of that, I'm talking about a true long-term investor. You have to have a defined time horizon. So are you wanting to be in this asset class for a quick flip or a cycle? Do you want to be here for 5 years, 10 years, or all the way up until retirement? And make sure you know that for every investment that you make, every single time you buy an asset, how long are you willing to hold that asset? What level do you want to sell at, or do you need to sell at if things don't go your way? Or what level are you actually going to begin DCAing during volatility? When are you going to take profits, and when would you cut your losses, if any? An investor with a plan never overinvests early, and what I mean by that is they are not putting all of their capital to work right away. They want to keep dry powder intentionally, so keeping cash on the side at all times. And that is so important to have in terms of discipline, because without that, you won't make it far. It's also very important to know your average entry price at all times for all different assets that you own. And yes, if you wanted to hold 50 or 80 different cryptos, you can. It's just a lot harder to track. It's a lot easier to track when it's under 5 or 10. And knowing your average entry price will help you pre-plan your dollar cost averaging levels and position size. So if you're buying at X price, what price do you need to sell at or just take a loss? Or what price, as you stagger in, do you want to DCA at to improve your position? And now I'll show you how planning can turn volatility into huge opportunity. So we're going to use an example where an investor buys Bitcoin at $100,000 and they have $100,000 to buy it. And there's a few scenarios. They could go all in and use all 100K and have one Bitcoin, or they could stagger their buys and be strategic. And we're going to use a boring but realistic example for a lot of investors that came in when Bitcoin was over 100K. I didn't want to use some example of buying Bitcoin at 20K and then selling. And this can apply to any asset. You can move the decimal places, etc. So we have this investor and they have $100,000 to invest, whether it's 1,000, 10K, doesn't matter. And what they did is they invested $30,000 initially when Bitcoin is at $100,000, so they got 0.3 Bitcoin. And what they did from a risk management perspective is they kept $70,000 in cash on the sidelines, so keeping dry powder. But let's say their time horizon is up until 2030. So what this investor did is they bought Bitcoin at $30,000 and they have a remaining $70,000 just in case the price doesn't go in their direction, and then they can strategically dollar cost average in. And this is an example if Bitcoin did drop and we filled all of those orders. If it didn't and it went up, awesome. You can take profit and make money at whatever you set your take profit to. But what this investor did is they did 5 entries for the remaining $70,000. So 15K when Bitcoin goes down to 90K. If it goes down to 80K, they would enter another 15 all the way down up until that $70,000 is used. And why volatility provides a huge opportunity, because if Bitcoin did drop, he would fill all of these orders. And with Bitcoin dropping, this investor invested $100,000 and accumulated 1.3 Bitcoin with an average entry price for Bitcoin at $75,800. That's a much better average entry price than just putting all $100,000 into Bitcoin at 100K and just getting 1 Bitcoin. You have much more Bitcoin this way, and by doing this, they lowered their average entry price by over 24%. Now that doesn't sound like a lot, but when prices go up and you're taking profit, that makes a big difference. Now with this strategy, there wasn't guessing, they made a plan in advance. They weren't panicking if prices did begin to drop. And if you didn't have a strategy and you bought at 100K, we crashed to 80K, maybe you ended up just capitulating and exiting crypto, calling it a scam when Bitcoin hit 60K. So you would have just lost your money. And by having a plan, you are deploying capital with intention and you are improving your average entry price. And the opportunity with volatility when you have a plan and you DCA is massive. So let's do scenario A. There was no plan, no dollar cost averaging, and let's just say that they bought the $30,000 or invested 30K when Bitcoin was 100K. So you got 0.3 BTC. Let's say that Bitcoin got to 150K, you sold, you had a $15,000 profit. Now this investor could have also invested all 100K at once, bought 1 Bitcoin exactly. Selling at 150K, you'd make a 50K profit. However, the DCA strategy makes significantly more profit, all by having a plan and strategically entering, whether you did 5 different buys or 2 different buys. So it's the same market, the same price action, and the same volatility. And this was done without leverage, without trying to guess the bottom, just staggering different levels that made sense, and without any emotions. And although this investor improved or lowered their average entry price by 24%, the profit was a lot greater. So I hope that makes sense and it gets you guys thinking about this a little differently. So we already went over a lot of rules about not panicking in the middle of a liquidation, especially when you have a plan, you know your time horizon and your risk appetite. You're not over leveraging, you're not over allocating, you're not chasing, and you always keep dry powder. But one of the most important things is security and actually having structure. And during pumps and dumps, scams continue to increase, especially in today's world with AI and deepfake videos and these Sora videos getting more realistic than ever. Fake accounts are all over the place. There are phishing attacks and social engineering and fake phone calls from fake exchanges pretending to be supports. There are so many things going on. Or you could be like me and I actually sent my funds using a contract address that wasn't even the right crypto address altogether and I lost my funds. So human error or human mistakes play a big role too. And that's why security and actually having a structure is so incredibly important. And I have iTrustCapital linked in the top of the YouTube video description and in the first link in my link tree. I've had a Roth IRA with them since January of 2020. And they offer that structure whether you're looking at retirement via an IRA like a Roth IRA for tax-free growth or a truly secure system with a premium custody account. And this is a non-IRA account for anybody. You have a single dashboard, you have 90 plus crypto assets, you also have gold and silver to diversify, or you can even just hold cash and take advantage of dollar cost averaging. And everybody can choose. You can diversify, you can custody all of your assets in cold storage, which is perfectly fine, but that comes with risk. You have to manage and secure those keys correctly. If you lose those keys, you lose access to all of your funds. So just like you diversify in assets, I think diversifying how and where you hold your assets is also smart, just to limit exposure, not hold all of your assets in a single wallet. And I love iTrustCapital. It's a mobile app. I can trade 24/7, 365, and the trades settle within a minute. They are a regulated custodian, so they're actually using a qualified custodian. If I lost my funds, I get my funds back by law. They're highly regulated. They're not borrowing against your assets like we've seen a lot of other characters do over the years. You have the retirement angle, whether you do a 401k, a traditional IRA, or what I have, which is a Roth IRA, so everything grows 100% tax-free, and I can withdraw all of my contributions at any time, penalty-free and tax-free, so I still have access to those funds. And one thing I like about having a Roth IRA in the crypto space is it keeps a very long time horizon. I'm not panicking, I'm thinking long-term, years out. Even if I have real holdings or short-term holdings in crypto outside of this, having a retirement account keeps that long-term exposure and that long-term mindset. And I really like the flexibility of having a Roth IRA. Again, it's $0 a month. There are no monthly fees. The only time I am paying anything is just a 1% transaction fee if I buy or sell. So basically no different than Coinbase except for retirement where it can grow 100% tax-free. And some really nice things about a Roth IRA is one, I can set a beneficiary in case anything ever happens to me, and I can have multiple. So I can have one in crypto and gold and silver with iTrust, and then I can even have one with Vanguard and just invest in the S&P. So that flexibility as an investor using different investment vehicles is really important. And for anybody that doesn't like an IRA account, they don't want a retirement account, they can have a premium custody account. And you have access to over 90 plus different assets to buy and sell 24/7, and most importantly, you have tax reporting. Considering that we're now in 2026, this is going to be very strict in the future. And leveraging a closed loop system with this, you are not getting hacked. So it all comes down to everybody's preference if they just want to be all cold storage and take that risk, or if they want to diversify, but a closed loop system with a premium custody account has a lot of pros, with all necessary IRS and tax reporting. And I use cold storage today, but it is a pain in the butt when you want to trade. I mean, sometimes you can connect to a DApp, but sometimes just to buy or sell, I have to withdraw it from my wallet, I have to send it to the exchange, hope I sent it to the right address, cross my fingers, make the trade, when I'm done, I put it back in my wallet. It's a pain in the butt. So some people just want simplicity and security, having peace of mind when they go to bed at night, and that's exactly what a PCA provides. So if you get started today, make sure you use the link in the top of the video description or the first link in my link tree. You can scroll down, you can click Get Started, it's super seamless. And then you can choose between an IRA or a premium custody account, or even both. And I want to emphasize the market opportunity for retirement, the asset class to enter the crypto space. So here's a 2023 report, this is on congress.gov, basically estimating that there was $11.5 trillion in IRAs, with $37.8 trillion held in US retirement accounts, or plans. And fast forward to today, January 15th on ICI.org. I believe this is the Investment Company Institute, and they released their quarterly retirement market data for January of this month. So in terms of a lot of market data, this is fairly recent. The total US retirement assets were $48.1 trillion as of September 30th, 2025. And get this, for IRAs or individual retirement accounts, they totaled $18.9 trillion. So in this, we can see where a lot of these are invested and assume most of these plans, but point being, even if a small percentage of retirement accounts gets exposed to the digital asset space or crypto assets, in the future, it's huge. Now, iTrustCapital is the biggest and largest IRA platform with $16 billion in transactions and over 200,000 accounts. But realistically, thinking about the $18.9 trillion in IRAs today, how much is actually in crypto today? 5 billion, 20 billion? Absolutely nothing. And guys, let's just assume for easy math that IRAs climb from $18.9 trillion to $20 trillion in the future. Even 1% is a huge amount. And there are plenty of options with a lot more on the way as regulations improve, but they also allow staking. Now, friendly reminder, not every single asset or network is proof of stake, but they do allow staking for Ethereum and Solana today. And that's an amazing way for long-term holders that put their assets to work. Similar to DCAing, you are still adding to your position over time. So I really hope everybody enjoyed today's video, explaining the difference between an emotional investor and a planned investor. And you can find all links in the top of the YouTube video description, and big thank you to all that hit the like button. Stay safe out there, protect your capital, and protect your mindset. Until next time. If you enjoyed this video, be sure to smash the like button and let me know your thoughts down below. You can find all links to my crypto resources, including tools for charting, trading bots, wallets, portfolio trackers, and exclusive discounts right in my link tree in the video description. Thanks for watching, and I'll catch you in the next one.